Okay, so picking back up where we left off in the last series or last video, number 5. This is number 6. So I think we're all familiar with spot accounts. I think most people, if not all, get their first or their first experience in crypto trading via a spot account, where you just put money in, you buy the assets you want, and you get the asset delivered to you. So I think we'll skip all that. We'll go into derivatives. And guys, I'm not editing these videos. Like I said, I'm not interested in being a YouTube personality, so just bear with me. Coinbase Pro, obviously that's an example of our spot exchange. Like I said, we're going to skip over those spot exchanges and go directly to derivatives. So this is a BitMEX. This is BitMEX, their exchange. And they were pretty much one of the pioneers of crypto derivatives. Here we have a futures contract. So before we get into it, I think needs to be an understanding that when I refer to an asset, that means what we are trading, right? Whether it be Bitcoin or a company's stock. Asset is what we are trading. Now, when I refer to an instrument, know that what that means is that that's how we trade the asset. That's how we trade it. There are 4 instruments that fall under the derivatives category. And let me pull up this slide that I made for you guys. All right. There we are. 4 instruments that fall under the derivatives: swaps, perpetuals, forwards, futures, and options. And I hope to one day be able to do a series on options for you guys once we get done with the main TA video series, which could take some time the way things are going. But for now, I'm just going to focus on futures and perpetuals. There are also a few different flavors of futures, such as inverse and linear, and that goes for perpetual as well. But for the most part, these two are what I will be using for trading examples in these videos: inverse and linear. So what are futures? Futures contract is simply an agreement between buyers and sellers for a specific price, date, and time. Now, our trusty Investopedia, which I will admit, it's good for definitions. That's about it. They give a more a comprehensive definition, and that is: futures are a derivative financial contract that obligate the parties to transact an asset at a predetermined future date and price. So basically, the buyer must purchase or the seller must sell the underlying asset at the set price, regardless of the current market price at expiration date. There's some terms that you need to be familiar with for futures. Premium. If you remember our last slide, we skipped over that part, and that's something I don't need to miss out for you guys. Hold on, there we go. Or this one right here. So how do we differ, or how do futures differ from spot trading? Well, one, and this is the primary difference: future contracts expire at a specific date, right? Number 2, at expiration, those contract values will only ever be equal to parity of the asset's spot price. Number 3, at expiration, futures contracts are marked using the exchange's index price. And you may be asking yourself, well, what the heck is an index price? We'll get in that a little bit later, but for now, know that it is an exchange price calculation that is derived from a performance metric that the exchange uses or has. Number 4, current value of a futures contract can either trade at a premium, discount, or in parity of the asset. So how do we know when either of these are applicable to our contracts? Well, this is where these terms come into play. All right, so premium, when futures are trading at a premium, the contract is then valued more than the spot price and will usually converge closer to the contract expiration. So as we get closer and closer to expiration, the price will converge. Well, the futures price will converge with the spot price. As every day it gets closer and closer to expiration, they will converge together. So when they are trading at a discount, it's when the contract is valued less than the spot price. You know, traders can then speculate spot prices will fall in the future as contract expiration approaches. And normally, you will only see contracts trading at a discount during times of bigger downtrends. So parity. Parity is a self-explanatory term. It's used when two things are equal to each other. And in futures, contracts are trading in parity when they are equal to the value of the spot price. And also know that future assets can trade at a premium when the macro outlook, the overall outlook, is bullish, and can trade at a discount when it is bearish. And the key word there is can. All right. Now, so let me pull up our old trusty BitMEX here. Here's a futures contract for BitMEX. Index price is 67,132. We have an expiration date of December 31st at 6 a.m., basically in 2 months. So when this future contract expires, it is then settled. Settlement just refers to the finalization of the contract agreement between the parties, the buyers and sellers. As I previously stated, settlement can happen, but it can happen in two ways. Either by settling in cash or physical settlement. Cash settlement is when the exchange between the parties is settled and delivered in a cash equivalent to the underlying asset. Now, physical settlement is when the exchange between the parties is settled and delivered in the underlying asset that was traded. So, for instance, commodities like cattle or corn, or even our love of Bitcoin. There was a funny story a couple years ago. Going on a couple years ago, right after the COVID scare, the big dump we had across all the markets. Well, people saw oil dumping, and they were jumping in, brand new, inexperienced traders jumping in oil futures. And one guy was panicking because he got informed that he had a bunch of 55-gallon oil barrels on the way for delivery, and they were asking where did he want them. So there's typically when settlement comes, there's typically a per contract fee at settlement and delivery that the exchange they handle at settlement. It's just part of it, part of the delivery process. And we'll go over funding and settlement and fees in the next slides to come. In conclusion, futures, versatile asset, versatile trading instrument for buyers and sellers that want to take either long positions or short positions. And contract details right here, BitMEX, and most of the exchanges are similar. They have a little help or documentation where you can go in and get the contract details. Highly recommend you check that out. All right, back to our trusty slides. Next, perpetual swaps. These are my favorite. So the perp product, the perpetual, or AKA the perp, was first introduced by, or at least to crypto, by Arthur Hayes, the infamous Arthur Hayes of BitMEX. BitMEX and the boys, they created this back in 2014, and it became a very, very popular trading instrument in the crypto space. So what are they? Let me pull up BitMEX again. This is a perpetual. So, what are they? They're categorized as swaps in the derivative world, and there's several flavors of them. Just like the futures we were talking about, the two flavors we're going to talk about in these videos are inverse and linear. There are a few others though, but we really don't see them in crypto. BitMEX does have one or two more, I think. I'm not sure. Like I said, I use Bybit, but BitMEX is great for tutorials, and a lot of people still use them. Perps are also similar to regular futures contracts, except, and this is the key difference, except that there's no expiration date. Hence the word perpetual. So since there's no firm settlement date, the position that you trade can be held for as long as you want. However, there is a funding rate, so hold time could depend on how high the funding rate gets. It gets up there and it's hitting you real money, you may want to let go of that position. Depends on the funding rate though. And like I said, we'll go over those in the next videos. So how do perpetuals, similar to spot trading, or how are they similar to spot trading but different from futures? How are they similar to spot trading and different from futures? They're similar to futures, but are considered a margin-based spot asset. Now, they're similar to spot, but there is no expiration date. And they're similar because it's a margin-based spot asset. There is a funding mechanism that is tied to the underlying asset's spot price and doesn't trade with a premium, unlike future contracts can. Number 3, leverage multipliers are usually the same as futures, with some crypto exchanges offering up to 100x, and I think there are some offering 125x now, which both of those are just very ridiculous, and I've got to tell you, I highly advise to stay away from that stuff. 100x, even 50x and 25x is ridiculous. You don't need it. If using 100x, for example, if price moves against you just 1%, that means your whole position could be liquidated. And in Bitcoin, for example, 1% is nothing. So please consider your leverage. Number 4, similar to futures, contract details usually can be found on the exchange website along with the funding rate information. We talked about that just a second ago. I highly suggest you familiarize yourself with this data if you ever choose to trade any of these instruments on derivative exchanges. Number 5, perpetual prices, perp prices, are usually pegged to the underlying asset's price, where futures move closer to spot price as contract expiration approaches. Our next slide gives us a couple of snippets from BitMEX. So we have got our perpetual contract here and our futures contract here. Both have the pricing source as their index, like we spoke about. Index price, a little bit different. Open interest, funding rate, and open interest is a topic we'll cover as well later down the road. It's actually important to my primary trading strategy. The funding rate for perpetuals is usually every 8 hours. It can differ from exchange to exchange. We've got the expiration date on the futures. We don't have that on the perpetual. Remember, perpetual. All right, so because perps do not have that expiration date, there's that funding fee mechanism. Its primary purpose is to balance out supply and demand in the market by incentivizing either buyers or sellers to take opposite sides. The funding fee is usually every 8 hours, and it's a dynamic number. But again, check with the exchange you're trading on. It may be different. I doubt it, but it may be. So I'll go over some more stuff about funding and the fees and stuff like that in those videos to come. In conclusion, a lot of assets to trade within crypto perps. Not all exchanges offer the same, Bybit now has a ton of different assets to trade and is adding more literally daily because I get notifications. I've said many times Bybit is my favorite exchange. Let's see here. Yeah, see, I mean, they're every day there's a banner here with something new. Let's see what they. Oh, and wow, Bybit has their own spot market now too. I did not know that. See what they've got for derivatives. So, perpetual, inverse perp, inverse futures. God, but they have a ton of perp contracts. Ton. So that means we can not only take long positions on all these, but we can also take short positions. This is BitMEX's future contract right here in trading, and then here's their perp. I think that about wraps it up, though, guys. Like I said, I'm trying to put out one video a day for you guys. Just bear with me. And that's it. You guys have a good night or good day wherever you're at.